Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 22 years in the game, so you can skip the mistakes that we've made and go straight to property investment success. Welcome, Jez. How are you?
Good, thanks. How are you?
Good, mate. What are we talking about today?
All right, I wanted to do a heads up for newbies, new property investors. What have you got to be aware of?
Gotcha moments. Is that what we're after today?
Yeah, gotchas. Yeah, what are the gotchas?
Yeah, I think I can definitely relate to this. I guess starting out, it was difficult as a property investor because
you got
to all these seminars, you read all these books. I'm like, which approach is best? This person's learning to invest in Queensland, this one in Sydney, this one over here, and it's just like analysis paralysis. Now I realise after so much experience is work out what your goals are, what you can afford, get into the best area, keep it simple. Don't worry about these complicated structures that accountants try and set up. Find yourself a good accountant. But did you want to get started?
Yeah. It's funny you mentioned all those property investing books. Some of them can be a really great source of kindling.
Okay. What do you mean kindling?
If you're out in the bush and you need to start a fire.
That's funny. Yeah. What do you think, percentage-wise, how many?
I'm not going to come up with a number. I haven't done the stats on this one. But, I remember saying to you years ago, to go from novice investor to expert, first thing you got to do is write a book on property investing, because it seems like all the novices do.
Are we going to have a book soon or what?
No books for me.
I remember we did the seminars and all that. This was back in maybe 2014, 15. I was going to it all, and I remember hearing you were on a podcast. It was Ryan McLean's On Property podcast. I don't know if I don't think he still does it, does he?
Yeah, I've lost touch.
I'm like, this Jeremy guy, he's not bad. He's talking about data, numbers, didn't feel salesy. I really like the fact that you got to the point, and I feel like you're still the same. So,
hopefully I can keep the same. Yeah.
Yeah, but I think it's just, from my experience, seeing a lot of clients come through the door, they don't know where to start.
Yeah. Education. You got to learn.
And trust. Finding someone that you really trust. And I always advise, talk to 2 or 3 different companies if you are looking to get professional advice about getting a plan done or buyer's agent service, whatever it might be. Sit down with them, work out what your goals are, and then go from there.
Yeah. Actually, I've always said educate yourself. Number 1, you've got to educate yourself. But I think there's a number 0. It comes before educating yourself. And it's being aware of all the marketing tricks that you're going to get bombarded with, because there's a lot of deceptive content out there. And I would challenge most newbie investors to just have this healthy level of skepticism. I mean, what's healthy is a bit subjective, but in general, just be a little bit skeptical. Ask questions like, how does this bozo get paid? How are they getting money? Is it coming from me? There's some... you think about a mortgage broker. A mortgage broker doesn't get paid. You contact by you, but they give you advice. Buyer's agents, they definitely get paid by you. Property developer, how do they get paid? Just keep asking questions. How does this person get paid? I mean, we get paid because we're selling data, all right? So obviously we're going to be pro data. You want all the data. You should be buying all the data you can get your hands on. That's our bias. But everyone has a bias. And so if you can just have a healthy level of skepticism, I think that'll go a long way. So the first thing I would say is learn the marketing tricks that you're going to be bombarded with.
Yeah, and just like I said, have multiple sessions with maybe different companies. I think there are a lot of them are complementary. Obviously, you're giving up your time to have these meetings, but I think it's good to bounce ideas, and maybe one person compared to another can give you some great insights.
Another one, is this person spinning facts or opinions? Because there are opinions are in oversupply, in my opinion. Opinions are in oversupply. I don't want to hear another opinion. Show me the data. Show me the facts.
Yeah. I'm all for opinion. One thing I most probably don't agree with is when I hear that this is brand new is the best, or this is the best. This is my strategy. This is cash flow. Like
it's a bit
instead of saying in my
black and white.
opinion, this has worked for me. This is an example. Just really lay it out instead of sort of being that sort of push mentality, trying to get a deal over the line. Because I think that's what frustrates me the most within. I guess look, it's about marketing, isn't it? I don't like to harp on it a lot, but it's just look at yourself, where your plans are head, what your goals are, and just do one step at a time. Yeah,
there's a lot of data or research. Well, it's packaged up as data and research, but really it's just marketing.
And the thing is with data, obviously we've got a data business, but it's like compare it. Like compare our data with maybe another data company out there. Okay, are they different? Are the same? I would argue I wouldn't just look at that one suburb in isolation. I want to look at a local government area that has a lot of strong suburbs within that pocket, correct? Because it gives you a bit more of that comfort. Okay, well, nothing's ever 100%. What we want to do is limit the risk, and we want to increase the probability in getting into a solid market.
Yeah, and although I don't want to pump up our competition, data is so cheap. There's no reason why investors shouldn't be looking at multiple sources and perhaps, cross-reference.
Yeah.
So, not trying to pump up our competition though.
No, but I think it's just good. It's good to do your own research, and I know it can be overcomplicating, but, look at like different data points from different companies. Go, or is this suburb over here saying, it's hot, but then over into this other suburb, it's not that great from another company. So you're getting misled, or maybe they're both the same. They're both good markets. That might give you that validation to go, great, you know what? I'm comfortable now to put my money into this area.
Yeah. And I think that, another thing that novice investors need to be cautious of, and I've spoken about this before, about the marketing. Does the founder of this business, do they come from a marketing background or public relations or sales? Because that can be a heads up as to what they're going to lead with. Are they going to lead with product and service, or are they going to lead with marketing? And there are some companies out there where it is just all marketing. You are just buying rubbish, just nonsense. Now, these are extreme cases, but I think that investors need to be aware that there's a lot of money at stake here. You buy a $500,000 investment property, which if you're in Sydney and Melbourne sounds really cheap, but that could be financially life-ending. You make that sort of mistake. So you do need to be very careful, and there are marketing monsters out there salivating and jostling for position, looking at the next sucker that's going to be born, and they just want to gobble you up. And there are property developers that are they're not running a charity. They are hunting for dollars, like property investors are. We're hunting for dollars, but you are their prey.
And you need to do your research.
Yeah, you need to do your research.
Due diligence, as I said, look at multiple companies, do your research, take your time, and don't feel like you have to rush.
Yeah, that's right. There's a big discussion about analysis paralysis, and sometimes it's used to pressure newbie investors into making a decision. But property just doesn't move that fast. You can take your time, and if you're unsure, I would say there's a good reason why you've got this fear. In most circumstances, fear is a healthy thing. So you need to address that fear. Why is it I'm not confident? It's because you don't have enough information. You haven't done enough research. You don't have enough data. You don't have enough facts to back up and make your decision feel confident. So, back out, do some more research and have another crack at it.
Yeah, I know I definitely had that analysis paralysis years ago before I joined a buyer's agent or property investment company around 2016. But I remember early on, like the seminars, the books, they're great at the marketing where they pick someone from the crowd. Oh, yeah, I purchased the property, did really well. And or they'd done a course and it's worked out really well. So that marketing ploy, they get you to stand up, clap your hands and high five and really get you pumped. And it's like, motivational. But I feel like I've seen it all now. So I think just take a step back and don't ever feel like, I'm missing out. Like you get into the market when you're ready. No one can ever time the market, but you can sort of limit risks and increase your probability of getting it right.
Yeah.
And I'll bring up an example actually, but I had a client that purchased a property in Footscray, Victoria. So not like a west sort of Melbourne CBD, in one of these big high rises. So 2017, guess how much this gentleman paid?
Okay, so going back, what are we talking about, half a dozen years from now for, what, a two-bedroom unit?
It was 2-bedroom.
I mean, without looking it up, I'd say it's like, what, $500,000, something like that?
Yeah, it was 527, and it sold for this year for 450. So a drop of 77,000 in a period of about 5 to 6 years.
So they're paying interest on their mortgage for all that period of time. They're waiting, they're wasting their life away, and it's actually gone backwards.
And that's where you have to make a call. Okay, so I have to take this hit, and then it's like, okay, well, if I'm going to sell this property, can I move that money into a better type of asset? Let's say good land content, good solid house in a growth market, but $77,000 drop. Yeah, you'd have a bit of depreciation benefits there, but this is, I think, a key thing as a newbie. Don't always go cash flow, cash flow, cash flow, because a lot of these marketers are going to sell you this brand new unit where it'll cost you $20 a week. It's gonna grow by this much, and then when it doesn't, they're off. They've collected the income or the revenue from the sale, and then you're stuck with this lemon of a property.
Yeah, that's right. It's interesting that property developers will do some research, but all their research is focused on the feasibility study for their project. Once they've made their profit and they've sold, why would they bother going to the trouble of doing research to see what's going to happen in the future after they've offloaded their asset? The most amount of their research is conducted in the feasibility study, and the research that happens at sale time is not research, it's just marketing. How do we flog off this property?
And I think it's maybe more validation, maybe to go, oh, here's a report, the numbers are saying, there's going to be population growth. Well, what they're not telling you, okay, there's population growth, but that means there's more dwellings coming on the market. If there's no more dwellings coming on, well, where's the population growth in that area? They're all just going to go further out, aren't they?
Yeah.
Which is quite interesting.
So that's, one of the big mistakes I think that most newbies make is they are attracted to the new properties, the new developments, the glossy brochure, and they're suckers to the marketing, and that's why they probably underperform. They buy a new property, it has very low capital growth, it has high depreciation, which is the opposite of capital growth. They're focusing too much on the cash flow, and they get disappointed by the whole experience.
Yeah, I think the thing, it is a good ploy, isn't it? I'll buy a property that's going to cost you $20 a week. Fantastic. I get a property that's only going to cost me this much, but you're not factoring in, is that asset going to grow over time to build your wealth?
Yeah, and there's some interesting research that Luke Metcalf of microburbs.com.au that he did not so long ago, where he found out that the typical investment property, this is looking at data over the last few decades, the typical investment property in Australia has actually underperformed the national growth rate. So here are property investors, they're buying property for a financial decision. Owner-occupiers are making a lifestyle decision. So I can understand if you're making a lifestyle decision, you pick a property that has some inferior capital growth or cash flow. That's fine, because you're not buying as an investment, you're buying for a lifestyle decision. But they have actually outperformed the people trying to make a financial decision by pursuing supposedly high capital growth properties. And I suspect it's because a lot of investors have bought new, or they've been overly obsessed with cash flow.
Yeah, I think that's the normal one, isn't it? Cash flow.
Yeah, I think it catches people out. I mean, obviously there's no problem. You've got to have some cash flow to retire on eventually, but that's the end game. The start game is the capital growth. And I think too many investors, they don't think through, all right, I've bought a property that's putting $100 a week into my pocket. So over the course of the year, I'm $5,000 better off. But over how many years do you need that $5,000 to build up for the deposit for the next property? How do you get the next one without any capital growth? So, yeah, cash flow is important, but it plays second fiddle to growth.
And the way to work out that cash flow is, well, what's your current lifestyle? And I've spoken about it before, but let's say, your income coming in, let's say $10,000 a month overall, like your income from your employment, maybe some rental income, dividends, and then you've got your expenses. But let's say you're saving about $4,000 away every every month. Well, it goes, okay, well, 4,000, let me inject that into either I can pay down debt, I can put it into a property portfolio to generate that asset base. So yeah, you might have that negative gearing early on where it might cost you a little bit, but as long as you can afford that and you've got that that security behind you, i.e. cash reserves in an offset account, you put yourself in a solid position, I feel.
Yeah. And you know what? I don't think it's this whole property investing thing is that hard for newbies. It's actually quite easy as long as you get just a couple of things straight. Number one, buy a house rather than a unit because houses have outperformed units. Number two, don't buy anything new because old property outperforms new.
Yep.
And the third thing is just avoid vacant land where there can be lots of development creating oversupply into the future. So you buy in a built-up area, buy an old house in a built-up area. If you have time on your side, that is almost a foolproof strategy for a newbie.
Yeah, the other thing is too is like with that vacant land, I've mentioned it earlier, is if they're only releasing, let's say, 200 or 250 a year, but then you go to their sales department and you know there's 10,000 people waiting for blocks, you're going to see some capital growth, aren't you? Because you know that the demand is there for these certain blocks. So you can look at recent sales. It's just obviously that waiting for that registration. That's a bit more complex, I think. I think to keep it simple, establish property in a decent area. And I think, I don't know, what are your thoughts on this, Jez? Like, I find maybe these days there's a lot more buyers agents or investment firms that target established. Like, you know, our data, we're all about established. But I think that's what I believe. Where if you look maybe 7-8 years ago, a lot of them were maybe like brand new properties. So when I've seen clients go in, they go, oh, I made that mistake. You know, now I realise that, you know, we should have bought an established property somewhere. But I feel like there's more buyers agents that are focused on really looking after people.
Yeah. I mean, I guess there were some disreputable ones years ago that would have some sort of arrangement. Maybe they shouldn't, but they might have had an arrangement with a property developer, or maybe they just thought, oh, well, these are no nonsense. You don't have repairs and maintenance. You get a higher yield. But they're much more educated nowadays, and I think that most buyers agents, especially the ones that I talk to, are definitely opposed to buying new. Because
a new one might, like I've seen, again, clients come in, they go, oh, brand new, but I don't have like repairs that I have to worry about. It's easy. But, you know, I've seen people with 50-year-old properties that they only maybe spend a couple $1,000s. So when you do your building and pest inspection, I mean, a couple $1,000s a year for maintenance, sometimes even like $500. So when you're doing your building and pest inspection, just ensure that there's nothing major, I guess, wrong with the property that's going to cost you an arm and a leg down the track.
You know, it's interesting that property developers will claim that they've got this great bonus, depreciation benefits. I mean, there's no such thing as depreciation being beneficial for a property investor, okay? But they label it as depreciation benefits, but they will never talk about repairs and maintenance benefits that you get for having an old property. Obviously, it's a loss, so there's no benefit. It's stupid calling it a benefit. That's just marketing magics.
But we've got the land,
property. Yeah, that's right. Higher land asset ratio. That's right.
All right, awesome. Anything else to add, or are you happy?
I think that's pretty much it. Yeah. It is actually simpler than you think. If you've got time on your side, you buy in an established area, you buy an old house, make sure it's a house, nothing new. And you're pretty much set. It's almost foolproof, really.
I think you block out the noise, and if you're time poor, you can use maybe like a buyer's agent, look at multiple firms potentially, or you could do like a property course, but then you're injecting your time. So do you have the time to be able to do a course and learn, which I think it's a great thing to learn.
It's always good to learn.
But then you can go, you know, I'm time poor, I'll use a buyer's agent, get the deal done, buy a good property, but just make sure you ask those questions if you are using a buyer's agent. And if there are comparable properties, I know which one I'm going for. Do you know which one that would be?
Higher land asset ratio.
Yes, land to asset ratio. So, look, thanks for listening. To stay updated with our property insights and content, Jez, what should everyone do?
Subscribe.
Like and share to the world.
Share to the world.
See you in the next episode.